Panel 3, CEF execution facilities. We're going to focus a little bit on this made available for trade determination that we have coming up that obviously makes a big difference to these markets. On the 15th, we have Vince McGonigal for a repeat performance, Director of Market Oversight, and we'll explain kind of the commission position right now. And then we have, what do we have? Four other participants to talk about package trades in the market, their impact, to help us understand them trade by trade and some of the challenges, whether it's technical, operational, or jurisdictional. And then we have Scott Fitzpatrick to kind of remind us of MAT is not the only issue facing CEFs, and that there are some other handful of issues that he's going to touch on, and we're going to then open up for discussion, and we should be done by 8, 9 o'clock tonight. So I apologize for running over, but we'll try to keep this tight. If your presentations can be tight, we'd greatly appreciate that. Thank you. Vince, all yours.
Thank you. Good afternoon. What I'm going to discuss, so just briefly touch on the registration process, the made available for trading determinations, and the package roundtable that we have scheduled for Wednesday morning. And before I even get there, I think the first place to start is to point out and thank the staff within the Division of Market Oversight and other divisions that were confronted with a pretty big burden in the fall of 2013 during the time of a government shutdown and then subsequent furloughs here within this commission, but particularly stayed focused on the fact that we were looking at a temporary registration process for, at the time, was 19 CEFs, and then applications for, or determination, self-certification for contracts to have made available to trade mandate. And the teams have been working continuously, evaluating not only those determinations, but the issues that relate to a good and steady progression towards the transition to compliance with the trade execution requirements, which are currently starting on February 15. So very much appreciate the work of the staff and their ongoing work as we go through working on these issues and hopefully getting to an area of smooth transition in the coming days and weeks. With respect to the MAT applications, the Commission received 5 made available to trade determinations via, which is Part 40.6 of our rule, for certain interest rate swaps and certain credit default swaps. 4 of the 5 MAT determinations have proceeded. There's one application for self-certification, which is open for a 90-day window pursuant to Commission rule, which will hit that window in the beginning part of March. The review process for a made available determination is fairly discreet. The staff presentation requires that one of 6 factors for a CEF to meet under 37.10 or for DCM and 38.12. Those 6 factors are whether there are ready and willing buyers and sellers, frequency or size of transactions, trading volume, number and type of market participants, bid-ask spread, usual number of resting, firm or indicative bids or offers. So the Commission's regulations require only one factor to be considered, and each of the MAT applications, their filings address multiple factors. The standard review with respect to the MAT determination process is to evaluate whether the filing is inconsistent with the Commission's regulations or the Commodity Exchange Act. Otherwise, the swap becomes subject to the trade execution requirement. The division, upon receipt of the application, stayed those applications for a period of 90 days, citing the complexity of the questions presented. By staying the applications, that allowed there to be an open comment period, which was a mandatory time period for 30 days. Approximately 20 comments were submitted with respect to the MAT applications. So at this part, I just want to touch just a little bit about process and the communications that we had with staff had with the applicants, which was focused on, we conducted our evaluation of consistency with the Act and regulations. We evaluated the comments that focused on those factors for determination, one of those mandatory 6 factors. We also asked questions of the CEFs. We particularly requested that the CEFs respond to the comments so that we were able to have a dialogue with the CEFs that took in questions or comments that we saw, but also incorporated those that came in through the public comment period, which was very important for us then to ensure that to the extent the public did have comments, that they filed those or got those to us in a timely manner as part of the process. The majority of the comments received by the Commission emphasized the need to limit the MAT determination to certain benchmark tenors. So there was some conversation or communication surrounding the scope of the products that were subject to self-certification. During the course of the fall, some of the certifications were revised and the scope of those certifications were narrowed somewhat. There were several comments that we received that were sort of outside of the MAT process. I know the Commissioner asked this morning about sort of what determination we had in play with respect to how we evaluated the comments. I'm reading a little bit more into his question than how he articulated it. But getting to the point of the division's obligation and the self-certification was very narrowly focused on whether the product as presented was one that could be self-certified. So questions that didn't relate to the 6 factors were not part of our sort of internal process, although they informed the division operationally about how we should be looking at trading on these complexes and questions that we had about transition. And what I'm getting at is sort of questions surrounding whether there should be a phased-in implementation schedule, package transactions, which I'll touch on in a minute, operational concerns, whether the CEFs were in compliance or not in compliance with the rulebook obligations. And just stopping there for a second, as part of the temporary registration process, the CEFs, of course, are obligated to ensure that their rules are in compliance with the Commodity Exchange Act and regulations. So, starting February 15, we will begin the process of those interest rate and credit default swap products that are now subject to the trade execution mandate. Over the past several weeks, we have been in communication not only with those applicants who had products self-certified, but the other CEFs, to the extent those CEFs are interested in also offering products that are subject to the trade execution requirement. So we are looking at operationally those CEFs who are indicating that they have the ability to trade the products set forth in the made available to trade determination. We then also are looking at this question concerning packages, and because words matter, sort of, what is a package transaction definitionally is something that we'll talk about a little bit more on Wednesday. But looking at, as presented by various commenters and in the application, where you see a grouping of transactions that involve 2 or more counterparties, 2 or more instruments, one of which will be subject to the made available to trade requirement, and as collected, that series of transactions are contingent. All components are contingent on the execution of each other. So, loosely looking at that, or specifically looking at those as sort of some guidelines for packages, the question presented to the Commission and to the division in particular is how do we transition swaps that are going to be subject to the made available to trade determination onto CEF when there are products being traded or relationships that parties have entered into that will have multiple components. And I'm looking forward to having and hearing more about those issues as today and as we get into the upcoming weeks. The division under the guidance of the chairman is looking at relief for surrounding packages for an interim period so that we can get to transition over the course of the next few months and think thoughtfully about how we introduce those package transactions onto CEF. So some of the questions that we'll be talking about. Yeah.
Maybe I'll just chime in right here.
Sure.
Sorry to interrupt, but we will release a letter later today along with a press release that provides some temporary relief in the manner that Vince generally describes. So those transactions that include multiple component parts, including a swap subject to the mandate, will have relief from the mandate until May 15th. We'll continue sorting through this both today and on Wednesday at the roundtable to figure out a more thoughtful solution to these types of transactions. But as I said, we'll release the letter later today. There's a few other things too we're going to do. One relates to making it clear that anonymous trading on the CEF will remain anonymous, and so we've done an interim final rule that addresses that, which is to say a party to a trade cannot learn the identity of a counterparty by accessing the trade repository. We're also going to provide guidance later today related to how consent to jurisdiction can be provided to the CEF. And then finally, I think it might already actually be on the website, but we're going to have a central location on the website that clearly identifies which instruments are subject to the mandate. There have been some questions after these press releases in response to the MAT submissions have gone out as to which precise instruments, getting into some detail about terms, which ones are actually subject to the mandate. So in an effort to clear that up, we'll have a central place where that information will be provided on the CFTC website. So I thought it might be appropriate this time to announce that to the group here, but look for those three different documents later today. And as I said, I think the website probably has information about the mandated swaps already. So, sure.
Is that envisioned as a hard deadline, or is one that could be extended further?
Well, as I said, I think it allows us more time to figure out what to do or what the right approach is to these package transactions, and so it certainly doesn't foreclose additional action. But I don't want to predict one way or another what exactly we'll do. But we have some flexibility with that date, I think.
Thank you, Mr. Chairman. And I also want to thank the Commission, too, for their input as we go through some of these transitional issues, as particularly, Commissioner O'Malley's office, even in sort of discussing a game plan around packages and evaluating how we can build in some time on this front end to seriously consider these issues so that we're effective in our response, and the Chairman's leadership has been very much appreciated as well on all of the items that we're talking about here today, and other issues yet to come out. On the panel for Wednesday, we've identified some areas, and then I'll stop in a couple of seconds. Clearing of package transactions, the execution. How do we stay focused on the required methods for execution as set forth in the CEF rule? There's been some question concerning whether or how we might use alternate methods for execution. What is a package transaction, sort of how it's defined, and this idea surrounding phasing, cleared versus uncleared products, products that might not otherwise be a jurisdictional product, but are nonetheless in the real world dealt with in these package transactions. So we'll be looking for substantive feedback on these and a number of questions that the team have prepared and plan to have a very robust roundtable on Wednesday. Thanks.
That roundtable's 10 a.m., 9 a.m.?
9
a.m., lots of witnesses.
Lots of witnesses. We have about 16 witnesses, so we try to incorporate. So what we're going to have is one table for 3 hours, and so we can bounce certain questions off particular witnesses, but then have the panelists give input even on those areas, of course, that they're not specifically directed to answer. And we think that's a way, given the time period that we have, would be the best way to facilitate a conversation.
I was just going to add one other quick thing. The purpose of all of these efforts I just mentioned before is, we're trying to figure out what obstacles there are to CEF trading. We're trying to eliminate those where appropriate, because what we're trying to do here, obviously, is maximize the amount of trading that's happening on these facilities, and where it's appropriate to address something even on a temporary basis that appears to us at the agency to be standing in the way and keeping people from wanting to trade on CEF or being able to trade on CEF. We want to address that and take away the reasons or excuses or whatever you want to call them some folks might have for keeping their trading activity away from these regulated platforms. So I can't promise that we've addressed every last problem that might meet that criteria, but that's certainly been the goal, and we'll continue working on other issues as they arise.
Thank you very much for that. I definitely support the relief, and have been working with the chairman on this. At risk of making your roundtable moot, we actually have 4 witnesses here that will walk through and explain the challenges or hurdles. And to the chairman's point, we do want on-screen trading, but based on the comments we received, and with all due respect to your characterization of how we came up with the MAT, what we can and cannot consider in the MAT determination is, it is important we consider some of the technical, operational, and, as you pointed out, jurisdictional concerns. And I believe once we kind of identify the packages and their different attributes and the individual challenges facing each one of them, I think we can tick off, over time and with the appropriate, certainty in the market on timetables or investments or technology requirements, that we should be able to take care of these things and bring them on screen as soon as possible. How you MAT a non-jurisdictional product is going to be interesting. I hope the SEC will be there, shed a little light on what they feel like, but I think the market is already solved for that. We can, whether it's matted or not, but they can certainly trade these things as packages and do so quickly and achieve the price transparency on screen and clearing. How we get to the absolute strictures of MAT will be interesting. But let me just start. We're going to go, actually, I think we're going to start with Sunil. And then we'll go with Stephen, Alex, and Mark, and then save Mr. Fitzpatrick for last there for the new issues.
Scott, if it's okay, Stephen could go first. He's going to do some foundational work.
Okay, never mind then. Ignore the chairman.
Thank you. I did have a few slides. I don't know if there's a way to get them up, but okay.
They should be preloaded. Yeah, there you go.
All right, great. So I thought just for some level setting, I'd start with the definition of package transactions, provide a few examples, talk about the economic benefits we see to package transactions, provide a quick analysis of the representative transaction costs of being able to do some certain transactions as a package versus having to execute their components on an outright basis, talk about some of the items we feel we need to address, and then our recommendations. But I guess, based on the news we just heard, I'd like to say that we're very grateful for the opportunity to have more time to flesh out these issues, come up with solutions. We do share the overarching objective of moving these package transactions onto trading platforms where they can benefit from the pre- and post-trade transparency and greater competition that can be afforded. So, we think it's a great first step that we have some more time to think through the issues. So, from a definitional perspective, I think there's probably a more technical legal definition that's been laid out in some of the requests for no action relief. But generally, when we talk about package transactions, we're talking about a transaction that involves the simultaneous pricing and execution of 2 or more component instruments. For our purposes, 1 or more of those is a MAT swap, and the others are either another swap that's not MAT or a cash bond or futures contracts. The transactions are a combination of buys and sells, or payers and receivers on a swap. There's a reasonable degree of correlation between the components, and the risk of the offsetting components is approximately equivalent. And in that context, we're talking about, in the rates market, we're talking about the interest rate risk So we talk about these transactions as being DV01 neutral or duration neutral. My comments today here are focused largely on the rates market, though I think analogies can be made in the credit markets, and I'll let others talk about that. So,
Stephen, could you pull that mic just a little closer?
Sure thing. Sorry, is that better? Okay. So some common examples of package transactions in the rates market I've listed here. I won't read them all, but you can kind of bucket them. There's multi-swap package transactions, so that's the curves and the butterflies, so where you're executing a number of clearable swaps. There's swaps versus securities, so swap spreads or MBS basis, where you're executing a swap against a government bond or an agency security. There's swaps versus futures, so an invoice spread, for example, is a swap versus a T-note future. And then the last is what I would call a cleared swap versus an uncleared swap. So something like a swap versus a swaption, and that's the delta neutral option packages at the bottom. Being able to execute package transactions as a package has a number of benefits for market participants. You get a tighter bid-offer spread. You only have to cross that bid-offer spread one time versus having to cross it multiple times if you had to do separate leg-by-leg execution. You get more targeted and efficient risk transfer, and you eliminate the legging risk, which is the risk that the market moves between each of the individual executions. So what I like to say is that package transactions aren't some form of financial alchemy. They actually do deliver real benefits to market participants, and they're commonly traded, and they're a kind of crucial mechanism for the global risk transfer system. I don't want to bore people with the details, but we've done some analysis here to look at what the representative transaction cost would be if you're able to execute a package transaction, or if you're forced to split up the execution of legs on an outright basis. So the next two slides is an example of a swap spread, which is a swap versus a treasury. And after that, a swap curve, which is two different swaps of different tenors. And what we found, using real prices that were quoted in the market, is that the cost of executing the two legs separately on an outright basis is triple. So you functionally triple transaction costs if you break up the simultaneous and contingent execution. So that kind of brings us to what we believe is the threshold point, which is that we don't want to break up the simultaneous and contingent execution of a package transaction. So that brings us to the question of, well, if one leg of the package transaction is MAT and has to be executed on a CEF and the other isn't, what do we do about it? Can we get it all on the CEF or can we not? So as noted at the beginning, we're not philosophically opposed to moving package transactions onto CEFs. We see that there would be benefits to that. It's just not going to be ready by, I think as we all acknowledge now, by February 15th. And so what are the hurdles we have to overcome to get there? One of the first items to address that we saw was for multi-swap package transactions, is there a communication protocol and an ability to do credit limit checking at the package level? And there doesn't appear to be today. When people execute a curve or a butterfly, those legs individually go down the execution to clearing workflow, and you can't do a pre-trade credit check at the package level, and the CCP, the clearinghouse, sees the legs come in individually, and so when they're looking at the risk that's presented, they don't appreciate that there's offsetting legs within that package transaction. So that's one item that we identified that needs to be addressed. For swap spreads, since you're executing a swap and a government bond separately, you want assurance that they're both going to clear/settle. We've also noted there appear to be some jurisdictional concerns about the trading of treasuries on a CFTC regulated platform. So that's something that, again, taking some time to think through would be of benefit. Invoice spreads seem to pose another challenge because they involve two separately regulated products in a future and a swap. And something like a swap versus swaption, it appears that maybe we can look to a model that's existed in the future space, which is the EFRP model, for some kind of off-CEF ability to execute the MAT swap leg off-CEF, but still subject to the rules of the CEF, and still be able to then pair it with a swaption. So our recommendations were first to do no harm, and again that goes back to the threshold matter of not breaking up the execution of packages as a whole. We think the industry is already, and some of the other panelists will probably talk about this in more detail, the industry is already working to identify solutions For example, the communication language around multi-swap package transactions. And we think, with some constructive dialogue with the Commission, we can find solutions to address perhaps the jurisdictional issues or whether there could be a EFRP-style solution for swaps. And thankfully, the last recommendation seems to have already been realized to some extent. So providing a little more time to think through these issues will, I think, be of benefit to the market. So thank you.
Scott, thanks for inviting us to this. This is obviously a topic that's near and dear to our heart, something that we've engaged the Commission about in the past. And so I think, Stephen covered the basic definitions, of packages. And I think, so it isn't, obviously the packages are already taking place, and those are similar to the ones that Stephen talked about. So packages are obviously taking place in the marketplace. They're taking place either via RFQ or via spreadsheets or instant messages. So it isn't that packages are not taking place. So what's the issue? What's the issue with packages? The issue with packages is that you can't just look at it in the context of, am I able to trade it on a screen or not? The question that needs to be asked is, does the infrastructure exist pre-trade, trade, and post-trade that can support the regulatory requirements and the compliance requirements that are required of all of us, to trade these instruments. And as we think about it, the complexity of the risk assessment, processing, protocols, and standards increases. So does the legal and regulatory matters as you go from packages that are entirely composed of MAT instruments. So you have a package of greater than one. Package that has greater than one MAT swaps. Then it becomes more complex. You have MAT swaps commingled with non-MAT swaps. And then you take it to a whole other level when you commingle cleared swaps that may or may not be MAT with uncleared swaps. And then you take it another level of complexity when you say you have instruments that are swaps that are governed by this agency, and then non-swaps that are governed by this agency. Then to talk about swaps that are governed by this agency and other instruments that are governed by someone else besides the CFTC. So that's the way we think about the complexity of packages. So we have come here on numerous occasions to talk about the technology and infrastructure that Truhex has built for packages under our PTC product. So, as we started interacting with FCMs, CCPs, buy-side firms, market makers, and credit hubs, it came to our attention that there was actually not a single protocol or a language to describe these packages. So the way they're currently done is you could have a buy-side firm that does a package of 100 line items, and each of those 100 line items are sent to the CCP, are sent to the FCM one by one, and there's no intelligence that surrounds the package that communicates to everybody who needs to touch it, whether it's the FCM, for pre-trade credit checks, CCP for clearing it and doing the risk assessments, or the credit hubs in the future to subtract the credit limits. They don't have an infrastructure that can process them as one atomic unit. They process them in a linear fashion. And we already know anecdotally in the marketplace that numerous large buy-side firms have had issues, operational issues, with the FCMs. Those, an example might be the first line item you send, is $1 trillion pay fixed in 30 years. And the remaining 99 line items, in essence, diffuse that risk. So you send the first line item, and for whatever reason, the other 99 don't get processed immediately. So it has a real impact on risk margin and the credit profile of the parties that are involved. And neither of the credit hubs have the ability to do pre-trade credit checks in aggregate for the package. And the processing At the CCPs, they can process them one at a time, but as I said, it doesn't exist to do them as one as one unit. And the regulatory framework does not exist, doesn't recognize packages, and doesn't exist to accommodate the time that's required for pre-trade credit checks as well as for the clearing from the CCP. So that is what we feel is missing in the marketplace. So, as Stephen alluded to, I think there's. So what's the solution? Someone asked me before the panel. That's great. There's going to be relief, but what's the game plan? So the solution is there needs to be a common standard protocol, because it's not sufficient for one or some subset of the parties to agree to a protocol, and they need to agree to the protocol on how to describe the container, how to describe the packages, but to also agree to the workflow, to agree to the CEF DCM workflow, as well as a non-CEF workflow, and also to make sure that the next versions of FIX and FPML take into account the protocols that have been largely agreed to by a subset. And so there's been a group of folks, including CEFs, FCM, CCPs, buy-side firms, market makers, who have actually made a lot of progress over the last 3 months. There's been agreement on the package IDs. There's been agreement on the line item IDs. There's been agreement on the workflows that are going to be required to process on a CEF basis, and an agreement on how to process it on a non-CEF basis. I'm not gonna bore you with all the details of the protocol, but they're available, and they take into account of the variety of different packages that both Stephen and I have articulated. Okay, so you need to make sure that the IDs are there and the workflows are articulated. So what's our recommendation? Obviously our recommendation is to not have packages be subject to the execution mandate on the 15th, and we thank you for already putting that into action. The couple of things to look at is to look at the time that the FCMs have to evaluate net risk, to look at the time that the DCOs have to evaluate the packages, and then we would have a checklist-like approach to make sure that there's a regulatory framework has been accommodated, and CEFs allow market participants to execute packages, and both the FCMs and the credit hubs have the ability to assess the packages as a whole, as well as the clearing organizations. And this is in our letter that we have previously submitted to the Commission. We would also urge this group and the Commission to look at a phasing and approach. Obviously, look at the most simple packages first, and make sure that there's no technology or operational nightmares, and then as we have successes, build on that and increase the complexity. Thank you very much, Scott.
Sunil, can you go on your chart on page 2? Are they in kind of an order of priority consistent with this phasing? You said address them kind of on a swap by swap or a package by package basis. You have a list of maybe 10.
Yeah, and and there's I'm not claiming they're complete, but yeah, I think the first 3 are the ones I think that may be in order, but then I don't think they might not necessarily be in order, because the 4th one commingles CFTC and a non-CFTC agency. So I think clearly 2 MAT instruments, a 5s versus a 10s, 2s, 5s that are both MAT. I think that would be the first one to tackle, and then tackle butterflies, and then tackle 2s versus 17s or something. I think to deal with integer swaps, MAT integer swaps first, make sure the infrastructure is there, and I think as I said before, there's been a lot of good work already done on getting folks that typically don't work together. They've been working together very cooperatively to come to an agreement on things that typically has taken years in the past to accomplish. So I would say start with MAT instruments first. Let's see how that goes. Get the infrastructure working, and get the credit. The most important thing is looking at the riskiness of the package and assessing the risk appropriately, getting all of that to work through the whole transaction lifecycle and all the handshakes to work. I think if you can do that in the first phase, if you can sort of kick it down the road, because clearly you've got the spigot, you can control the spigot. That would be the way I would think about it.
Well, just one quick thing I would add is that the first 3 transaction types on the list, those are ones where the industry for cleared swaps could solve it with the language fixes Sunil referred to, in terms of if the FPML language can be upgraded to communicate package transactions as a whole, that can solve the challenges associated with the first 3 on this list. Then we get into more, once we get past the first 3, we get into more complex, actual like legal jurisdictional questions on top of the just infrastructure ones.
If that's the case, and I guess we'll continue discussing this, but one of the suggestions there, and one of the other slides, one of Sunil's slides, was that we have to revisit the 1.73 or 1.74 concerning the speed with which the FCM has to reject a trade or not. If it's, I guess, help me understand that a little bit better if you can. Why would that be necessary? I thought if we were to just allow for some more time for technological upgrades and making sure the right connectivity is in place between all the different infrastructure participants, it should be easy enough, soon enough, for both the FCM and the DCO to assess the risk of a package transaction, especially if it's one just involving swaps.
Yeah, so that's a good question, Mark. So it takes time to message. Some of these portfolios can be quite large, and there's a number that they have been kind of converging to without the benefit of scale, automation, and technology, and that number is around 100, 150. There's obviously been some packages that trade in several hundred line items, but there's a reason that the industry has converged to a number like between 100 and 150, because the system cannot process them in an operationally efficient manner. So even if you could have a language that describes the packages, which there's a very good version of it floating around, you still need to communicate it to the CCPs. You need to communicate to the FCMs or the credit hubs. So that takes time, and then you have to wait for the turnaround time. So and there's a need in the world to do packages vastly greater than the line items that are being processed today. So there's going to be time that it takes to send it to whether it's the FCM, CCPs, or credit hubs, and then for them to do their risk assessment and then to communicate it back. And we've done some preliminary testing of that. We're happy to share some of the data, but I do think that those numbers will have to be reviewed because that may not allow enough time to process large packages.
Ananda wants to pipe in here.
If you guys have the technology to trade the package, how come you don't have the technology to compress it or send it to a clearinghouse? I don't get it. So you say it takes time for a credit hub to figure it out. It takes time for a clearinghouse to figure out how to clear it. Shouldn't it take the same amount of time for you guys to figure out how to trade it?
So yeah, I know you're absolutely right. The technology exists to trade it,
Right.
and the technology exists to communicate it.
Okay.
But what doesn't exist is a common language to describe. So we can send it to CME, LCH, we can send it to the FCMs, but the infrastructure doesn't exist to evaluate it as one atomic unit. So they can evaluate it on a line item basis.
Okay, but if the trader can evaluate it as one unit, I mean, the example you gave, right? Like so many bips is what you pay. Why can't you give that to? I don't get it. I mean, are you saying that the trading community is that much smarter than the clearing community? Or
No, I mean the analogy
is.
is, so let's say you go to Russia for the Olympics, and they speak Russian over there. You speak English. You're both communicating. You think you're communicating about the same sport, but you need a translator to get your language converted into the local language. That's really what we're talking about. So everybody can evaluate the risk,
Okay.
but there's not a consistent way to describe the package, and there's not a consistent way to keep track of the package, and a consistent way to evaluate the riskiness of it. That's all I'm saying.
And I think people can communicate bids and offers back and forth to each other about anything you want. I mean, any product or service anywhere in the world. I think the issue is that if we're communicating and market participants are pretty good at identifying what they're communicating a bid or an offer about, but if we decide we've agreed on a price for a swap package that's a butterfly and has 3 legs, and for some reason the FCM or the CCP sees the first leg and doesn't know that there's 2 more coming that have different risk characteristics than the first leg, they could make an errant decision based on just not having the knowledge that it was part of something else. So just the language that I think we're talking about is a flag that when someone receives a leg of a transaction, they know it's leg 1 of 3, 2 of 3, or 3 of 3.
What's
So-
stopping you from sending the entire package to the CCP? What's
Right now, the language doesn't support the wrapper.
The language.
But once the language is in place, right? I mean, then what's
Now,
the,
so we're, to get really nerdy, I mean, there's something called FPML, and FPML version 5.7 is due to, unfortunately, not come out till July, and they've agreed on the language upgrades they want to make to include a wrapper and to include the itemization, so you can say it's leg 1 of 50, 2 of 50, etc. And once that standardization of the language is agreed upon, people can start building to it even ahead of the July release date. But would have been great to solve that a lot sooner. But
Yeah, so Ananda, I mean, no work is stopping, so we've already adopted it, but it's, we need the industry to adopt it, and that's really what we're talking about.
So to the extent that anything you do in this package comprises a product that has to be cleared, you are sending it for clearing, right?
Yeah,
Okay.
absolutely.
Alex?
Yeah, thank you very much, Commissioner, for the opportunity, and also thank you for the relief. It's relieving, certainly. And
glad to hear it put that way.
And you'll also be relieved to hear that Stephen and Sunil got most of my points, so I won't be talking for very long. But I do want to Sunil mentioned that these packages are already happening in the market today, and I wanted to give a little bit of data as to how frequently they're happening. So swap spread trades, for example, benchmark swaps with integer tenors against benchmark treasury bonds is the overwhelming majority of the interdealer swap volume. Options with delta exchanged are also the overwhelming majority of the interdealer option volume, and approximately 40% of our volume with our investor customers. So not only are these transactions happening, they're happening very frequently, and they're an absolutely integral part of how people think about and manage risk. And I certainly share Stephen's 2 goals. I agree that we want to be able to solve this problem and get these transactions onto a regulated venue as quickly as we can. But I think as important is to ensure the continued ability of market participants to be able to execute these transactions as packages without having to break them up. Because in my view, the critical aspect of what makes a package, yes, it's done simultaneously. Yes, there's contingent pricing, but the risks of the package are almost by definition much less than the risks of the individual components. Otherwise, people wouldn't want to do them as packages. And so what we're seeing, and I think what we're thinking about, is not necessarily whether or not these packages should trade on a CEF, but how they should trade and whether or not they should be subject to an EFRP-like regime, a regime similar to the block regime or the order book RFQ3 minimum. And when you think about these trades, if one of the legs is a mat swap, and other legs are not mat swaps, I think the CEF community and the staff and the commission have spoken and said, well, look, on this 6-factor analysis, these other components of the trade do not have sufficient buyers and sellers, or are not subject to the clearing mandate, or do not demonstrate sufficient liquidity. So I think, while we think about how to get those trades onto a SEF and how to process them effectively, and ensure that the treasury leg settles, for example, or that the swap leg of a option with delta, if that swap is deemed to be void because it's rejected for clearing, we have something consistent to do with the option leg. I think are part of the conversation, and something that we need to be thoughtful about. And then finally, I want to make one point about transparency. And I know that when we look at the SDR data, we try very hard to eliminate as much noise as we can from the SDR data so that we can use it for the purposes for which it was intended. It's very difficult to weed out what is actually delta risk transfer and what in some cases is not actually delta risk transfer, because that particular swap is done concomitantly with a series of other swaps. So in Sunil's example, you have the $1 trillion 10-year swap and 99 other smaller swaps that offset them. You see the $1 trillion swap on the tape, you say, that's a big trade, a lot of delta just went through the market, when in fact a lot of delta didn't just go through the market. And I think we could enhance and we could borrow something from the equity markets, as FPML 5.7 gets rolled out and the wrappers are identified and designed. We could enhance the post-trade price transparency quite a bit, as well as the ability for the commission and staff to make sure that the package trades are not being used to evade RFQ-3 or order book trading, by using something to tie those trades together so that any participant in the market can see the option and the delta that was exchanged, the $1 trillion swap and the 99 other items, and really understand what was happening in the market and when it happened. And that applies on a pre-trade basis as well. I worry about doing a large out-of-the-money option trade with a client, and then both of us having to go into an order book or RFQ3 folks each separately in opposite directions in large amounts of duration, sending an actually false message to the market about the amount of buying and selling and interest that's happening. So I think we support the pre and post trade the benefits of the pre and post trade transparency that CEFs and the SDR and the reporting rules bring. And I think that just one thing to keep in mind throughout these conversations, that package transactions actually are quite complicated when it comes to that, and should be thought about carefully.
Thank you. Mike Hennessy, I believe I called you Mark earlier, I apologize.
No problem.
Who is Assistant Vice President, Treasury and Capital Markets, Federal Home Loan Bank of San Francisco. Thanks for coming all this way.
Yeah, no, thanks for having us. We appreciate the invitation to participate, and for the opportunity to talk about the Federal Home Loan Bank's unique version of package transactions, which has not really been explicitly addressed by some of the other market participants, either here or in comment letters on this subject matter. By way of background, as you may already know, the Federal Home Loan Bank system is comprised of 12 federal home loan banks and the Office of Finance, its fiscal agent, and was established with the passage of the Federal Home Loan Bank Act in 1932 to provide liquidity to the nation's financial institutions. Currently, and has been the case all along, the banks are cooperatively owned with approximately 7,000 member financial institutions, which include banks, thrifts, credit unions, insurance companies, and community development financial institutions. So that said, and moving right into package transactions, we agree with the comments expressed here by the other panelists about how important package transactions are, and that they need to be preserved for the marketplace. And we generally share the same concerns around package transactions, and agree with the Commissioner's observation that in many instances more time for package transactions is needed, especially for those combinations that involve swaps and other swaps. However, the trading practices of the Federal Home Loan Banks generally do not involve these types of package transactions. Instead, the Federal Home Loan Banks use packages in a unique way, and that is really limited to the negotiated swapped bond issuance package transactions. And, issuing debt in the capital markets in this manner is the primary mechanism by which the Federal Home Loan Banks fund themselves. We included some statistics in our comment letter regarding the MAT submissions, and I'll summarize those briefly here. Since 2008 and through the third quarter of 2013, about 73% of all debt issued by the Federal Home Loan Banks on account basis was done in a package. And on a notional basis, that's about 67%. So I think, it's obviously very integral to the Federal Home Loan Bank's business strategy. And I think I'd like to walk you through an example of one of these transactions and how they come about and who the market participants are in each of these transactions. So one of the key features of this type of transaction is that it's multi-party. So the Federal Home Loan Banks, our bond underwriters, and our swap counterparties have an open dialogue around our funding needs. And essentially each business day, the Federal Home Loan Banks broadcast to the marketplace where they're willing to issue debt on a package basis. So we generally take the asset side of our balance sheet and convert that to 3-month LIBOR. So we have these synthetic 3-month repricing assets, and we make the similar type asset liability hedges on the liability side. And so, we enter into these trends. We broadcast to the market participants that we need this specific funding level on a 3L basis, and bond underwriters and swap counterparties go out and canvass their investor base to try to deliver that type of package transaction for the banks. If they're able to successfully find investors or devote balance sheet to our debt issuance needs, they'll present us with an opportunity to say, Federal Home Loan Bank, San Francisco, would you like 2-year debt at LIBOR less 5? And if that's acceptable, a few minutes later, all parties to that transaction will hop on a phone call and read the terms of the bond issuance and execute that issuance, read the terms of the swap hedging transaction, execute that swap, and the Federal Home Loan Banks are left with their synthetic 3-month liability at LIBOR less 5. As part of that transaction, we're not negotiating the individual prices of the bond or the swap. Instead, we're solely focused on that net funding target. And this has a lot of advantages for the banks, most of which were already described by the gentleman to my right. But this is the most cost-effective way for us to issue debt. And we use it more than any other strategy as evidence to that. We're able to obtain better funding levels than if we were to just go out into the marketplace and issue a floating rate bond indexed to 3-month LIBOR. It also allows our debt to trade with greater liquidity as we're able to issue across the maturity spectrum. And it also reduces risks. Reduces risk for the Federal Home Loan Banks because we avoid legging risk associated with the timing of issuing a bond and subsequently swapping it. But it also reduces execution risk for all the parties of that transaction. And it does this by increasing the probability that the issuance and the hedging transaction occurs in the first place. If issuance and hedging was split apart, which could be the case as a result of made available to trade, it will increase the likelihood that these transactions do not materialize because bond underwriters will be focused on their customers' needs. Delivering a fixed rate bond, for example, with a specific coupon target. And that issuance of that transaction, while it might be suitable for the underwriter and their clients, the Federal Home Loan Banks are going to be focused on what that debt issuance swaps to on a LIBOR basis. And so the incentives are not well aligned. And so small market moves could cause deals to be turned down or not occur. And so that's an inefficient use of resources. So, we're concerned basically about the presence of this third party in the package transactions, the third party bond underwriter, excuse me. It makes it, in our idea, unlikely that these transactions will be able to be executed on a CEF. at least in the foreseeable future, there doesn't seem to be much, development around taking bond issuance and moving that into this electronic trading world. Yes, we're talking about swaps and bonds, which certainly seems to be in play for mandatory trading on CEF, such as the swap spread strategy, which is swaps versus treasuries. But that's a little bit different than what we're talking about here. The treasury note or bond is available on screen, and in many instances already trades electronically today. When you're talking about a new issue debt instrument, there's no CUSIP available. It's not really, you can't pull it up and analyze it, and that technology just is not in place today. That's really kind of the way that the Federal Home Loan Banks use package transactions, and we're supportive of moving towards electronic trading, and we think that it's best for the market, but we are concerned about this nuanced type transaction, and we're open for other ideas, because we generally like the functionality and the efficiencies provided by CEF, specifically around the speed of clearing and certainty of clearing, and would not be opposed to a regime that allows us to privately negotiate these multi-party package transactions, but still subject to the swap in that transaction to processing on a CEF.
Thank you. In this FixML 5.7, there are a couple of things on the bottom here of this mat to mat, mat to non-mat. Will this also be supported in a data repository and be informative? I keep thinking about all the questions, all the data harmonization issues we had in the first panel today, and Vince, I don't know if you've given this any thought, but maybe as part of your roundtable that at least we'll ask the right questions about how we designate this, and if they're going to make an FPML upgrade anyway, does that increase our surveillance capability and our ability to see it in the SDR? I know Saeed mentioned today we don't have a MAT designation. He's over here. So if you're looking, okay.
I was looking for my guys.
Oh, all right. Well, now you guys are working this cross-divisional. You're all one team, right? So
Exactly.
But maybe you'd ask that question and get some thought. And maybe somebody, Sunil, I don't know if you have a sense of if that'll help us in the SDR context.
Yeah, I think that was a really good point Alex brought up. And in fact, in the meeting that we had on Friday, there's 3-4 of the people from this group that are liaising with the FPML folks and Fix. And that was a discussion we eventually got to, which is, we need to make sure that the SDRs, one of the SDRs was present, the second one wasn't, that they also adopt the protocol, because I think, the point that Alex raised is very valid. You don't want to communicate, in a misleading fashion what the intent of that transaction was. So the codes that, this group has come up with, we would be very open to share them with all of the SDRs to say this is what, the FCMs, the CCPs, and the CEFs card hubs have agreed to. And I think that's a great idea, because it's going to mislead. The tape will be very misleading if, the risk will be grossly overstated if you don't flag it as such.
Yeah, I agree. There definitely needs to be some data reporting enhancements. Quite simply, the swap is not priced as a single leg transaction. It's inextricably tied to the other leg, and if there's not a way to identify that, it's definitely misleading in the repository.
It's interesting, and I definitely agree. It'd be great to flesh it out in more detail. I think that clearly, with respect to the real-time post-trade public transparency, it would be a great addition to be able to see things at the package level. Functionally, at the CCP, and in terms of kind of how things get risk managed, they still ultimately then get risk managed as individual line items, because they aggregate across a portfolio, and so there may actually be a distinction between what gets done at the CCP and the SDRs in terms of still keeping it at line item levels, but for the post-trade transparency, there would be value.
Yeah, I agree with that. I mean, they could be clearing at separate CCPs, or one could not be clearing at all, for example.
Vince, or anybody on the panel, this cash futures basis, these trades, futures don't trade on CEFs. How do we deal with that problem? I mean, at least that's within both are within our jurisdiction. We have rules that say, by the way, you can't trade futures on CEFs, but
Right, so I don't see, futures on CEFs are not permitted, so that is, I don't know that we're going to be, we will consider alternatives, but I don't know that we were planning on going down that route. I mean, certainly looking at these other sort of non-jurisdictional or products that aren't, or cross-jurisdictional issues, I think are some areas where there's room for discussion to see where we're going to go, but we haven't contemplated or talked about doing anything sort of on CEF that involves a futures product.
when you say we're not going down that route, meaning you're not going to mandate a package transaction with a benchmark swap and a future to be matted.
So I would be looking at maybe having another conversation about the fact that either you could do it would work to do packages on DCM, where they could do both futures and the trade executed swap, or they're going to have, whether there then be, if it's on a CEF, that it'd have to be busted up.
But let me ask a follow-up question. If a trader's looking at a screen and the screen is provided by an entity that's jointly registered as both a DCM and the CEF, first of all, I think that's a possibility, number one, and then number two, as a practical matter, under that scenario, probably wouldn't matter. Isn't that right, Vince?
That sounds right, but that was one of those things that I'd like to come back and talk to my group about.
I mean, if the RFQ is different, but again, theoretically anyway, if a package were listed on an order book and traded on an order book, it would seem that would be very much possible.
Yeah, we'd want to take that back.
Anybody else? Oh, Cliff, I'm sorry. And then Superna, I know you were.
Just obviously the timing of the administrative back end processing, the wrapper, the FTML is all important, and I'm not suggesting anything be done precipitously, but I would suggest that ultimately the package trades have to be brought into this framework, or the framework makes no sense. And you can't be half pregnant about requiring certain parts of this to be cleared without understanding that fundamentally, we talked about this before, the sequence of requirements is backwards. The trading requirement should have preceded the clearing requirement. That's water over the dam. But if you guys have a fundamental role of being concerned about systemic risk and not adding to the risk of these instruments now residing at clearinghouses, you're stuck. And every moment that these kind of arbitrage opportunities continue to exist, they will be exploited. I don't know, you've heard of the Cubs spread, right? The new swap product, which has a $1 bet attached to it that the Cubs win the World Series. That's not me making it up. That's actually a design to avoid either any of the requirements, either clearing, CEF, swap data repository. Now, I'm not saying that that's the purpose of this. Obviously, it has to be feasible to be able to move these into the environment. But it is not without considerable risk that the day in which you force the hard cutover, big bang, whatever you want to call it, to take place. And by the way, this is not risk unrelated to market circumstances. It is not without precedent that there could be a major interest rate movement. And gentlemen, you do not want to be halfway between these two worlds if that happens. You know, when margins are going to be readjusted in a major way. I mean, this is, you're on a path And I just would urge you to consider the risks of not seeing this through as expeditiously as possible. I'm not arguing with whether this was the right way to do it or the wrong way to do it. The legislation is very clear, and your purposes have been made very clear in terms of moving as much of you can into the new environment. Good luck. I'll be in Argentina, where there's a more stable environment.
I think, I'd like to thank the panel for giving us, good introduction into the main type of packages that exist out in the market. I'd just like to add, one comment about the package trades. Like each package, there's a reason for it. You may be hedging duration risk, or you may be isolating vol risk. So just to keep that in mind, because as clients, we're using these packages, there's a reason behind it. And if these packages are forced to trade independently or separately, apart from the fact that they expose us to all the risks that Stephen outlined as economic benefits, it also breaks our ability to be able to hedge or isolate the risk that we're trying to hedge. The other thing, that I'd just like to, ask, ourselves as committee members, as well as, our witnesses, we just got 90 days extension, and we really do need to have a plan of action on how we're going to get these trades either, matted, not matted, to trade on CEFs, or make a decision that we may be allowed to trade them off CEF and then just process them on CEFs. Otherwise, we're going to be back here on day 89 as clients, still facing the same uncertainty of premature movement onto CEFs, or like an infrastructure that really is exposing us to more systemic risk than reducing the risk that we're all set out to do. So, the ones that, I'd like to highlight, we need, the CEFs to be able to provide us the solution to trade these as linked packages. That's very important. I know we have some of the CEFs sitting out there, and then we also have, some of our dealer counterparties that, provide us liquidity. And then on the back end, whether we consider the clearing element of it or the limit checking, all of those need to take into account linking these transactions and looking at them as net risk, versus separate risk.
Brian?
I'd like to thank the panel also, and agree with much of what has been said here in terms of the need for time, and thank you very much, CFTC, for granting us some time in this regard. The CME has been working with the industry in terms of coming up with the mapping solutions that are required for these transactions, and I think the panel here did a nice job of laying out some of the complexities associated with doing so. But I also firmly believe that we can come to that resolution and to that solution. So this room shouldn't leave itself wondering, can this be accomplished? It can be, and there's very much a focus on making that come to fruition. Now, there is some point that has been made here, and I just need to clarify it. We suggest, use an EFRP transaction. It's been alluded to. Let's just be able to do that as maybe as a first approach. And I need to be very clear that that those around this table and those listening have an understanding of what we're talking about in terms of what constitutes an EFRP transaction. EFRP transactions have been in place for several years, and today that framework for these trades, it starts with Core Principle 9 for DCMs, and that requires that markets provide a centralized, open, and competitive mechanism for trading listed contracts, ensuring that the price discovery process in the centralized market is protected. Core Principle 9 grants DCMs the right, but not the obligation, to permit certain non-competitive trades from occurring and that is premised on the rules that are adopted by the exchange. So at the CME, non-competitive trades have historically been and will continue to be a very, very narrow exception to our centralized open and competitive trading in these contracts. Our Rule 538, which governs EFRPs in our markets, it limits non-competitive transactions, requiring them to be, one, privately negotiated, and also only over-the-counter contracts. That is, they aren't executed or subject to the rules of a DCM or a CEF, nor are they to be used as that related position component. So across all of our DCMs, EFRPs account for just over 2% of our exchange volumes. Now, the low percentage of EFRP activity does not necessarily suggest that market participants do not more broadly establish package exposures, as has been explained today, that may or may not involve our futures contracts. It means that they most commonly establish those exposures in a more competitive manner. At the CME Group, we prefer these methods of establishing package exposures wherever possible because, one, they contribute to the price discovery process taking place in a centralized market, and they facilitate a tighter bid-ask spread, and they enhance the overall transparency in our markets. Before the Commission were to consider expanding or permitting EFRP-like type transactions for CEFs, we recommend the Commission finalize the proposed EFRP regulations under Core Principle 9 for DCMs, which have been pending as a proposal for over 3 years. In our experience over the past 3 years, CFT staff has in many instances treated these proposed regulations as final without an informal staff, even an informal staff interpretation. And we believe that this action in the absence of final regs has created a lot of confusion in the marketplace. There's a lot of uncertainty in terms of compliance risk for exchanges, for FCMs, for brokers, and for market participants. So that's an area that I think we're going to have to tackle more deeply.
If I can, just before we go to the next, just to touch briefly on a different tack, to the extent that, and I thought I touched on this when we started, that the trade execution requirement talks about 2 required methods for execution. So to the extent that anyone is contemplating sort of some alternate method, please pay close attention to the discussion or if you want to challenge whether there was a discussion, the sufficiency of the discussion concerning whether alternate methods for execution are appropriate with respect to swaps subject to the trade execution mandate. So that's a way of saying, you know, the more legal analysis that folks want to submit to the Commission or to DMO in particular as we evaluate this with respect to what the CEF rule said, what comments were made around the CEF rule, what are the required methods for execution, including whether the DCMs are faced the same limitations as CEFs with respect to required execution methods, and then to the extent that folks want to articulate whether or how there could be an exception, that would be much appreciated.
Yes, thank you. First, I would like to thank the panel because it was a very, I would say, fascinating discussion about the value of those package transactions and the fact that we need to adjust the infrastructure that we have to accommodate those package transactions. The point I would like to make is the fact that the XML data representation is probably the easy part of all this. And I think the part of the cross-asset data representation is a big part. The fact that we will have, and you pointed out the case of OTCs, that will have a futures dimension, but also a security, the US Treasury example. And I think we will need to think about those in the context of CEF, but also the context of SDRs and Part 45, Part 43 reporting, which scope is currently limited only to the derivatives transaction. So I think we should focus early on with those assets that are not in the scope of Title 7 as to how we tackle those, because I just have the impression that this will be the difficult part of everything. And I was also wondering, in the commodity space, do we have also some package transaction that would involve physical commodities or any of those things? but that would not include a physical. That would be the OTC and the future. That would be the easy one.
Wally, and then we're going to go to Scott to remind us of the other outstanding SEF issue.
I think a lot of people, unlike myself, might be predisposed to saying if it's happening in the market, it should continue to happen. Unlike you, maybe I missed something. I did not hear why the Earth will stop rotating if package transactions are done in their component parts as opposed to all together. I hear that obviously that if a package deal is done, that means a lot of different swaps are going to get done, which would, if they were done in individually, we'd all know what the price is, and now we'll never know what the price of any of them individually is. I understand that if you own a bond and you hedge it with a swap, you're going to have to put a margin on the swap. I understand that you're doing your deals and you have to do 3-month LIBOR swaps, but you can do 3-month LIBOR swaps. The chances of you being foreclosed from the market are very little. And so what I hear is that people sort of want to do these, and I guess sometimes I hear that it's convenient, and somebody's been told there's an execution risk. I got that. Somebody's been told that it is a nice thing to do, but I also understand why it obscures the market, and maybe the world won't stop spinning if you can't do these. There's a roundtable coming up. I'm not asking you to satisfy my personal needs, whether it's based on ignorance or maybe lack of bias, one or the other or both. But I got to tell you, it sounds to me like enabling a system that isn't that really is a system that's created to create deals for folks. Look, for instance, if you cut the whole idea about paying three spreads, you come to me and say I want to do 2 or 3 swaps together, and I'll give you 1 spread. I'm going to go lay it all off, so I'm going to experience those spreads and pass the cost along to you, for instance. It sounds to me like a lot of this is a discussion that defies the laws of preservation of mass and energy, if you know what I mean. So not today, it doesn't have to be today. I'm not asking people to stay late or to satisfy me, and you don't have to satisfy me, I guess. But to me, that's, if it does sound a little bit troubling that the world will end if you don't do these things transparently in components as opposed to in big wads.
I think I'm willing to stay late to address that. I think there's the last part of what you said. It's actually, in many cases in practice, quite the opposite. So, I mentioned in my initial remarks that the interdealer broker market is, for interest rate swaps, overwhelmingly composed of spread trades. And the reason why we can price the individual singular interest rate swaps that our clients ask us to perform is because once we have that risk, we have 2 hedging tools at our disposal. We actually have multiple. We have futures, we have other swaps, and we have treasuries. And the ability for us to take the offsetting treasury risk, for example, and then transform that back into the swap that we did for our client is what enables us to make the prices that we do. So it's not even so much that we are passing costs along to customers because we have to go and do each of the individual legs separately and hedge each of the individual legs separately. Frequently, it actually works the other way. And we will hedge using the most available or the cheapest or the hedge that fits our overall portfolio the best, and then we'll do a invoice spread or we'll do a treasury spread to manage that risk.
But somebody has to get back to the underlying risks eventually.
Well, that underlying risk has been passed to us. In my example, that underlying risk has been passed to us by our client already.
The guy you do the spread deal with eventually, or somebody down the chain has to get to the actual real risk.
Well, somebody may have capacity for treasury risk, whereas we have capacity for swap risk, or that's the reason these things exist is because people have different portfolios and different goals. And I don't think anybody's suggesting by any means that the world will end. I think what we are suggesting is execution costs will rise, risks that neither party to a transaction want, they're going to be forced to have, or they will be forced to bear the execution risk, which you minimize a little bit, but I think it's real, particularly in volatile markets. And this is something that happens, very frequently in the market, and many of the suggestions that we've been making are designed actually to enhance the transparency of these transactions. So, for example, linking them on the tape is a transparency enhancing suggestion. The managing the clearing
Post trade,
sure, post trade,
not pre trade.
well, if you have an order book that's available, you can see where the price is, and I would also say that you can't quote a swaption in vol terms unless you can fix the delta leg. Otherwise, you have to quote the option in price terms, and as the underlying moves around, you're going to have to be constantly recalculating it. It's actually going to be much less transparent, I would say, because I could say, oh, well, I see treasuries at 9+. No, I see them at 9. Well, if we agree the treasuries at 9+, and we're going to exchange the treasury, we agree the 10-year swap is at 3%, we're going to exchange it at 3%. That makes the negotiation between the two parties to the swaption much more transparent and much cleaner, in my opinion.
I would just add, I think we should all be encouraged by the fact that execution venues are all trying to build better mousetraps for package transactions right now. Sunil could spend an hour talking about his, portfolio termination and compaction tool. There are a number of CEFs that already stream quotes for swaps, curves, and butterflies, and swap spreads. So, and I think we've discussed already how in the interdealer markets there's probably already great central limit order books for certain types of package transactions. So, there is a mechanism to see this work in, the post-CEF landscape. I think there's just, there's some hurdles to overcome to make sure it works seamlessly.
Thank you. Let's go to Mr. Fitzpatrick here and close us out.
Thank you, Chairman Amalia. For those of you that don't know, my name is Scott Fitzpatrick. I'm represented today here as the current chairman of the Wholesale Market Brokers Association, and also representing one of the firms that has a central limit order book for some of these package transactions. I was going to go into a little bit of a preamble, Scott. Oh, is it? Bring closer. Is that better? Okay. Can I rock it? Right. All right, we're good. In the interest of time, I was going to go into a little bit of a preamble on how we got here, but I will go straight to the points.
For the record, Amalia was shaking his head.
Exactly. I see the acknowledgement from the chairman. Thank you very much. And what I will say is that it isn't all bad news. Obviously, we sit here today and there's been a monumental effort that has gone on across the industry, not only from CEFs, but from swap dealers, major swap participants, ECPs, and also our international colleagues in getting as much of this market efficiently and functionally operational on CEFs as it can. However, in saying all of that, there are still a few issues out there that merit some discussion or some reference in today's TAC meeting. I've deliberately left off the package transactions, knowing the agenda for today, obviously, and coming up over the next few days. So what I want to do is just focus in on 4 of these areas. The first one being the confirmation requirement in Rule 37.6b, and more specifically footnote 195, and the obligation that CEFs maintain privately negotiated master agreements between counterparties. Second issue I'll touch on is the remaining cross-border concerns as they relate to counterparties and execution platforms. The so-called embargo rule we'll talk about as point 3, and its restrictions on disclosing trade information under the CFTC's real-time reporting rules. And finally, I'll briefly touch on issues having to do with post-trade, straight-through processing and the pre-trade credit checks, with the CFTC's guidance that trades rejected by clearing houses are immediately void ab initio. Originally, we were going to talk about each one and open up for discussions. I'm just going to barrel right through all 4, and if anyone has any comments or wishes to raise discussion points at the end, we can do that. So first of all, I'll touch on the confirmation requirements and specifically footnote 195. Under the final rule 37.6b, the Commission requires that at the time of execution, a CEF provide each counterparty to a transaction that is entered into on or pursuant to the rules of the CEF with a written record of all the terms of the transaction which legally supersede any previous agreement and serve as confirmation of the transaction. In the preamble to the final rule, the Commission stated in a footnote 195, that CEFs could incorporate by reference the terms of a separate master agreement as long as the master agreement is submitted to the CEF before execution and nothing in the confirmation terms contradicts the standard terms from the master agreement. As a result of the unexpected implications of this footnote 195, there is widespread confusion currently and uncertainty within the industry regarding how to comply with the final rule or indeed resolve to agree completely on the legal interpretation of this ruling. While certain market participants have engaged Commission staff on this issue, I believe the industry would generally agree that further clarification from the Commission is necessary. As a practical matter, and speaking on behalf of the CEF, it would be difficult, to say the least, for CEFs to house a complete and accurate library of the privately negotiated terms of freestanding master agreements between customers. Market participants enter into these bilateral agreements separately from CEFs, and as a matter of industry practice until now, these agreements are not provided to other entities, including CEFs. Even if some master agreements were provided to CEFs voluntarily, logistical difficulties would make it impractical for CEFs to ensure possession of all bilateral agreements, and secondly, accurate records, as these agreements may be amended and restated periodically, let alone the fact that the industry would be required to manage a vast matrix of which CEFs have which versions of which documents for which products on an ongoing basis. As I'll indicate on more than one occasion during this brief presentation, this is an example of a situation where the theory is simple, but the practical implementation, depending on where you fall in terms of the solution, are potentially complex and time-consuming, and arguably questionable in terms of real value to the Commission of requiring CEFs to maintain such a library, thus adding once again to the cost and technological stress points to the function of the markets. On cross-border concerns, while understanding that there are a number of ongoing compliance concerns related to the Commission's cross-border interpretive guidance and policy statement, I'd like to focus this particular point on the staff advisory issued by the Division of Swap Dealer and Intermediaries Oversight in November of last year regarding the application of transaction level requirements to activity in the US and the dislocation between the guidance provided to the trading community versus that of the CEF community. Staff Advisory number 1369 stated that a non-US swap dealer, whether an affiliate or not of a US person, regularly using personnel or agents located in the US to arrange, negotiate, or execute a swap with a non-US person, generally would be required to comply with the transaction level requirements. Notably, the division believed these requirements would also apply to swaps between a non-US swap dealer and a non-US person booked in a non-US branch of the non-US swap dealer if the non-US swap dealer is using personnel or agents located in the US to arrange, negotiate, or execute such swaps. That was quite difficult.
You want to say that again?
Right. No, I got it right first time. I'll leave it there. Earlier in January this year, the Commission requested comments on the advisory while providing no action relief under CFTC letter number 14-01 to extend the time for non-US swap dealers to comply with certain transaction level requirements to September 15, 2014. Though this no action release provides relief to non-US swap dealers, it leaves open numerous cross-border questions related to CEF trading. At the same time, while relief has been given to non-US swap dealers, there has been no corresponding relief issued in the context of platforms operating in an execution capacity for these entities. To put this into context of TAC and apply the technological concerns, they are simple to describe again, but complicated to implement. Trading platforms are extremely complex pieces of technology. Any changes, even the slightest of them, take time to assess, analyze, define, code, test, and implement for the simple reason that if they go wrong, they can have a significant financial impact on liquidity, and worst case, a client position, and as a result, run the risk of damaging the relationship between the user of the platform and the provider of the platform. Having situations like the one I've just described in play currently seriously impacts day-to-day decision-making as to how you run your platform from a business perspective, a regulatory perspective, but also where you dedicate resource to make things right. When you don't quite know what is right and you're overstretched on your resource as it is. Leaving that one there, touch briefly on the embargo rule. The embargo rule covered under Commission Rule 43.3b3, which generally prohibits a registered CEF or DCM from disclosing swap transaction and pricing data related to publicly reportable swap transactions before public dissemination of such by an SDR. As a result of the rule, CEFs and DCMs that would like to continue to permit workups may face workflow issues, or in a more simplified fact pattern, cannot share trade information with their customers until confirmation that the SDR has published the information or that the CEF or DCM can confirm transmittal of the required information to the SDR. This delay can have material effects on market liquidity. Anecdotally, I'm aware of potential remedies that include providing an exception to this requirement so that CEFs can publish information simultaneously at the point to which the swap goes to the SDR. However, even that is laced with confusion in the context of direct connection to an SDR versus the use of third-party technologies, and at what point transmittal of information has been deemed to have happened. All that said, the reality of this situation is that the workflow complications are real, the practicalities of the required technology solutions are real, and the impact can be severe. Finally, on the 4 points, and the end of my reminder of that there's other things going on as well as package transactions. Pre-trade clearing certainty. In September of last year, Commission staff released guidance on the straight-through processing of swaps, reminding market participants of their obligation related to swaps on a CEF or DCM that are intended to be cleared. Among other things, the staff stated that clearing FCMs must screen orders for execution on a CEF regardless of the method of execution, and in turn, CEFs must permit clearing FCMs to screen on an order-by-order basis. The staff also noted that the Commission's regulations require CEFs to have rules to facilitate prompt and efficient processing by DCOs, and DCOs to accept or reject trades on a CEF or DCM as quickly as would be technologically practical, as if fully automated systems were used. And under the guidance, any trade that is executed in a CEF or DCM and that is not accepted for clearing should be void ab initio. Subsequently, staff issued a no action letter 1366, which stated that, subject to certain conditions, a CEF would not be subject to enforcement action for implementing the rules that established a new trade, old terms procedure until June 30th, 2014. Before I conclude, I just suggest that the issues here for discussion take on several forms. Firstly, the readiness of the marketplace to adopt the various methods and sources of the credit management process. Are platforms and the credit hubs ready with fully tested models for all market types, central limit order book, RFQ, voice, on a push and or a ping basis? Is the concept of a one and done on a trade that failed to clear for non-credit reasons realistic and acceptable? As I understand it, historically, trades can and do go through several iterations of resubmission before ultimately clearing. What if the trade that fails to clear is a component part of a package transaction? And finally, is the time limit of 30 minutes for resubmission acceptable? At this point, I would like to thank you, Mr. Chairman O'Malley, for the opportunity to speak here today, and I'll now hand it back to you to close.
Well, thank you very much for doing that. I'm sorry we won't have more time to discuss it at this meeting. I did want to think about those. I know that cross-border will be taken up on Wednesday, so that's that's a great development. And some of these other things we'll continue to look at. I'm grateful for all the participants, everybody that rearranged their schedule to accommodate the snowed out date. Grateful for the panelists to make their arrangements. I'm grateful for our staff that have participated in this meeting, have stayed in here to listen to all the recommendations that have been made today. So with that, we are done. Thank you.